Welcome to the Deep Dive. Today we're really tearing into the PepsiCo Q3 2025 earnings release and that Q&A session that followed. Now, for you listening, this wasn't really about, explosive growth. It felt more like corporate hygiene.
That's a good way to put it, yeah.
Yeah.
PP stock had been, sluggish this year. And then you add the pressure from Elliott Management, the activist investor everyone knew was involved.
Right, so the market needed something solid.
Exactly. They were looking for a clean slate, a sign of strong execution, and frankly, just some relief. And PepsiCo delivered that foundation. The results gave this, necessary psychological boost, drove the stock up quite a bit. Management presented this really cohesive, disciplined narrative. It was all about aggressive cost control and strategic repositioning.
Okay, let's unpack the core financials first. Just how solid was this clean beat?
Pretty solid, actually. The headlines hit the marks investors needed. Core non-GAAP EPS, $2.29. That beat consensus by about 3 cents. And revenue came in at $23.94 billion, just a hair above the $23.83 billion consensus. So that's like 2.7% year-over-year growth.
And the guidance, because that often moves the needle more than the quarter itself, right?
Absolutely. And the guidance held firm, which signals confidence. They reiterated the full year 2025 outlook, low single-digit organic revenue growth, and core constant currency EPS looking roughly flat year over year.
But there was a slight tweak on FX.
Yes, exactly. And that was pleasing. They trimmed the expected foreign exchange headwind slightly. It's now forecast at about 0.5 percentage point, down from 1.5 points. It's modest, sure, but it implies this little bit of unexpected leverage in the second half.
Okay, so management points to international resilience and those domestic cost actions. But how much of this is just pricing power versus actual volume growth? That's always the question.
It is the critical question.
Yeah.
And look, pricing is still favorable, no doubt. But the real strength of the international business, it's undeniable. And it feels less reliant on just pure inflation pass-through. That global segment is really the main engine of accretive growth right now.
And domestically?
Domestically, the positive story is definitely underpinned by those cost actions they're finally taking. It signals management is, willing to make some painful moves to right-size things against the current demand, which is, let's face it, more elastic.
Okay, this is where it gets interesting, though. The numbers behind the core beat, that gap between reported GAAP EPS $1.90 and the core EPS $2.29. Remind us, what big charge got filtered out this quarter?
Yeah, that's a substantial difference, almost entirely driven by one significant non-cash charge, a $133 million intangible impairment.
An impairment on?
Specifically tied to the Rockstar energy brand.
Ah, Rockstar, well, right down there.
Well, it signals that Rockstar's growth projections, the ones that sort of justified that acquisition price, they just haven't panned out. It's a direct result, really, of intense competition. Think Monster, think Celsius. They've just been eating market share.
So even with the core beat, that brand weakness and maybe product mix hurt actual operating profit.
Exactly. Operating profit was actually down year over year because of those impairments and the mix issues. However, cash flow is still robust. Year-to-date operating cash flow hit $5.47 billion. And that's funding a pretty hefty total cash return this fiscal year, projected around $8.6 billion between dividends and buybacks.
Okay, moving beyond the numbers, the biggest qualitative news felt like that leadership change. Bringing in the finance head from Walmart U.S., that's the biggest customer, right? That feels like more than just a standard CFO swap. It's a bit of a power move.
Oh, absolutely. Steve Schmitt coming over from Walmart U.S. Finance. He's succeeding Jamie Caulfield, who's retiring in November. The investment community sees this external hire as really strengthening their commercial and, importantly, their retail finance chops. And it comes at a critical time, right, when you've got activists scrutinizing everything, showing you can pull top talent directly from the retail front line. That's a huge confidence booster.
Okay, so financial stabilized, new CFO coming in. Let's talk about the tough part, the operational surgery. Management got pretty detailed about right-sizing the North America snacks business, PFNA. How painful is this cost crucible going to be?
It sounds like radical surgery, not just a little trim. This is really the cost of complexity. Coming home to roost, they announced 2 plant closures and a significant 6-year rationalization effort.
How significant?
We're talking about cutting roughly 15% of their snack lines in Q4.
15%? Wow.
Yeah. It's basically an admission that managing that long tail of low-volume niche products was just killing margin and operational bandwidth.
And they emphasize this isn't just a one-off fix.
No. Not at all. These productivity levers, they're designed as sustained interventions, expected to continue right into 2026. The goal is rationalizing warehouse infrastructure, right-sizing the go-to-market structure, especially as labor market stabilizes a bit. They need the savings to fund future investment, sure, but also to keep products affordable for consumers who are clearly price-sensitive right now, trading down.
Okay. That sustained cost focus naturally leads to the margin outlook. Management expects overall improvement driven by, two segments again?
Primarily two things. First, the continued expansion of that accretive international business. That's key. And second, margin expansion over in North America, beverages, PBNA. The hope, the expectation is that after this intense restructuring snacks, PFNA will also start bending the curve upwards on margin too.
Got it. Let's briefly touch on that regional optimization strategy, the One North America idea. Where are they with integrating snack and beverage distribution?
It seems to be progressing, but cautiously. They confirm they are actively testing the concept in Texas. And Texas is fascinating because it apparently offers the biggest opportunity due to huge differences in their market shares there between snacks and drinks.
Interesting.
But management really stressed this won't be a one-size-fits-all solution for the whole country. It's going to be nuanced, market by market, focused on optimizing the entire P&L, not just chasing distribution cost savings.
Okay, shifting back overseas, the international side carried a lot of weight this quarter. What gave them confidence there, especially after maybe a weaker summer?
Yeah, that international momentum bounced back fast. They mentioned a slightly weaker summer, blamed it on localized weather in some big markets, but performance in September apparently surged. It brought the segment right back to that mid to high single-digit performance range.
Any specific regions standing out?
They called out great growth, specifically in the Middle East and Brazil. Brazil, they said, was approaching double-digit growth. This kind of consistent global resilience, it's really the structural pillar holding up their whole growth algorithm.
All right, let's talk innovation. The CEO calling fiber the next protein. That's a pretty big strategic statement. What does that actually mean for their products? Are they changing the core snack DNA?
It's a huge signal, isn't it? They're clearly positioning the company for this evolving health landscape, especially, with GLP-1 drugs becoming more common and just broader consumer focus on metabolic health.
So fiber is the next protein. Why?
The CEO framed it as a major market deficiency and a key benefit for that GLP-1 era consumer who might be looking for, early satiety-controlled glucose response, things like that.
So future innovation is explicitly focused on fiber-forward products.
Absolutely. Sounds like a concerted push. We're hearing about prebiotic and fiber beverages, GLP-1 adjacent hydration platforms. One's focusing on high fiber, electrolytes, and protein. And alongside that, they're pushing harder on relaunching core brands to make sure they hit that long-term growth target in 2026.
Okay, give us the highlights on those core relaunches.
Well, the Pepsi brand relaunched, the one focusing on zero sugar and flavors, they say, that's already driving strong global momentum. And importantly, relaunches are coming soon for 3 other top brands, both U.S. and globally: Lay's, Tostitos, and Gatorade.
Gatorade relaunch. Interesting, given the competition there.
Exactly. And they specifically mentioned focusing heavily on communicating its, quote, superior hydration credentials to fight off challengers. Plus, you've got new product platforms focusing on no artificials, like that Naked platform, and even shifting oils, introducing avocado and olive oil versions of some snacks.
And M&A still plays a part, like the increased Celsius stake we saw.
Yep, portfolio reshaping is ongoing. They talked about the benefits of increased physical availability and growth from recent investments like Poppi and, yes, Celsius. What was interesting was the rationale they shared. Basically, use internal platforms like Muscle Milk and Propel for protein, where they already have credibility, but acquire externally, like Poppi and Celsius, where they either lacked a platform or just needed immediate scale and trendiness.
Okay, let's address the elephant in the room. Elliott Management, the activist investor. Management called the dialogue constructive, but what are the actual sticking points, if any?
Well, management stressed it's been collaborative, and importantly, that both sides agree the stock is undervalued. That helps. They also asserted that most of Elliott's ideas, especially around cost-cutting and simplifying the portfolio, are actually already part of their existing strategy 2030.
But the bottling structure, that's still the main point of contention, isn't it?
It seems to be, yeah. While they say they're continuing dialogue on bottling, management was pretty clear that the final decisions on supply chain and go-to-market will prioritize what the future demands. That means catering to big, concentrated retailers and the booming digital and delivery channels.
Using all that tech investment they've made.
Exactly. Leveraging those massive tech investments from the last 5 years to optimize the whole company P&L. They're focused on the long-term solution, which, might not perfectly align with the kind of immediate financial restructuring an activist might push for.
Makes sense. And the market clearly liked the overall story. The stock finished up, over 4% on the day?
It did.
That kind of quick jump suggests maybe the market priced in a lot of that near-term optimism pretty fast. Around the cost cuts, the new CFO.
I think that's fair. Which conveniently brings us to our final segment, where we pitch an outrageous but plausible trade idea based on everything we just discussed.
Okay, let's hear it. And remember, everyone, this is not financial advice.
Right. So given that strong initial relief rally, the pop in the stock, I'd pitch something I'm calling the deleverage delay trade.
Deleverage delay. Okay, lay it on us.
Uh-huh.
What's the thinking behind betting against that immediate euphoria?
It comes back to that North America snacks business, PFNA. It's undergoing, as we said, radical surgery, 2 plant closures, that huge 15% SKU cut. And it's all supposed to happen in Q4.
Right, the execution timeline is tight.
Very tight. These deep cuts, major operational shifts, they introduce significant complexity and, crucially, execution risk. Right now, in the immediate term, it's just really hard to rip out 15% of your product line and close plants without some kind of short-term disruption. Maybe volume takes a hit, maybe margins get temporarily squeezed by inefficiency.
So the bet is on execution risk being the biggest immediate overhang. But wait, isn't Elliott Management being involved kind of a safety net here? Wouldn't they be pushing management incredibly hard to execute those Q4 cuts flawlessly, precisely to keep the activists happy? Couldn't that smooth out the very disruption you're betting on?
That's a really good point, a valid challenge. The pressure is definitely on.
Oh.
However, the sheer complexity of a 15% cut across the board, across potentially complex supply chains, it just makes truly flawless execution really, really difficult in just 3 months. Mathematically improbable? Maybe. So the trade idea would be something like buying a near-term bearish put spread on PPA.
Okay.
It's essentially a bet that this operational complexity temporarily trips up Q4 execution, causes a short-term disappointment in volume or maybe margin before those long-term margin benefits from the cuts fully kick in later in 2026. It's basically betting that the cost of this complexity leads to a temporary speed bump, letting the stock pull back a bit from that initial post-earnings high.
Gotcha. A short-term skepticism play against that longer-term operational conviction. Okay, fascinating. So to quickly summarize for you listening, PepsiCo delivered that clean core EPS beat. They brought in a highly respected external CFO from Walmart. They reiterated guidance but trimmed the FX headwind. And strategically, they committed hard to aggressive cost control. That 15% SKU cut is huge, paired with a very consumer-forward innovation focus, especially around fiber and those GLP-1 adjacent products.
It really does feel like a decisive pivot point for them.
Okay, so we heard management clearly state that fiber is the next protein, considering their big push into functional hydration protein solutions already. What other overlooked, maybe core ingredient deficiency beyond just fiber might be the next multi-year growth catalyst for packaged food and beverage companies? Something else people aren't getting enough of.
Something to think about for that future portfolio. We'll leave you mulling that one over. Thanks for joining us for this deep dive into the PepsiCo call.